Hey guys, in this video, we're going to talk about some more position management. Now, we just talked about rolling options in our last video, rolling them in, out, up, down, and just kind of how that works and what that looks like if you would like to manage a position early by rolling rather than just closing out. So today, we're going to talk about managing a position by letting it just expire and then getting assigned, and actually what happens when you do get assigned. We kind of talked about this in our strategies, talking about are the short strangles and the covered calls, etc. Wheel strategy. But we're just going to go a little bit more in depth in here and exactly kind of what happens and in what strategies can you actually get assigned, etc. So today we're going to open up our June monthlies here in DraftKings. So we are going to have let's just open up a short strangle right here. Let's just go go around the 30 delta. Again, classic short strangle here, 30 delta. So we're currently going to collect right around 188 on this trade. Obviously, this is not a trade that we would do. This isn't far enough out for us to collect enough premium. But anyway, max profit right around 188. So what would happen here is we know our max loss is going to be infinite to the call side, because if we expire above this break, or if we expire above the 53 fives here, then we are buying back 100 shares of DraftKings here, and then we have to sell them at the 53. And we know our max loss for the short put is going to be just purchasing 100 shares here. Now, what happens here on the short strangle if DraftKings starts going against us, meaning we're kind of volatility is increasing because IV rank is high or low, so it expands a little bit, and all of a sudden we get really volatile, and then we just break below this 48. All right, and it's not looking good. It's just expiring day by day is going by, and we're down here at the 46, 45s. Nothing's happening. We're just losing more and more money. So what happens in this scenario is the first thing we want to do is we always want to try to roll the untested side and collect more premium. So collect more premium, collect more premium, collect more premium. That's our first goal. But it can get to a point where you're actually inverted in here to where your calls are now here, right? So you're short the 42 calls and you're short the 48 puts or something like that. You can get that far. Or if you don't want to keep on rolling, let's just say we roll to the 52s and you say, you know what, we give up. We're just going to call this one a loss. We're going to collect as much as we can on the call side, but we don't want to keep rolling closer and closer. We don't want to get whipsawed, right? We don't want DraftKings to all of a sudden just bust through, and now we're short the 48 and 50, and then all of a sudden we're expiring up here at 53, because then now we're losing on the call side. So what you can do is you would go ahead and let this whole position in here expire in the money. Now, whenever you have a short leg of anything in the money, you do have a chance of getting assigned. Now, if you do not have a long for protection, right? So we're not spread it out here with a defined risk on anything on the put side here. So this is straight, naked, short put here. And because it expired in the money, we have a chance of being assigned, and we will be assigned. So what that means is that now we just purchased 100 shares of DraftKings at 48. Now, some brokerages, when you do end up purchasing these 48, if you have a margin account, it will only be the 50% that you have to put up. I had a long call in Peloton that actually expired. It was a lotto, and then it actually expired in the money by a couple cents. So I actually got assigned 100 shares of Peloton, but it just took out the 50%. So it didn't take out the full, 100% that you would pay for 100 shares. It was just the 50% margin. So some brokerages do end up doing that. But so that's what would happen here on DraftKings. And if you're fine, if you're okay, if this helps you in the long run, if you're, well aware of what's going on in DraftKings and you're fine with this, you believe, you know what, I'm still getting a deal here at 48, then that's a good strategy to have, because now you have more intrinsic value. because you actually have something, you have stock in your hand. Rather, if you're just trading options, you have just speculation on speculation, right? You have really nothing that you're just trying to grasp onto, some theta decay, some IV expansion, contraction, but you really have nothing of value, right? But now, if you're fine with getting assigned these 48 or the 100 shares at 48, well, now you have something intrinsic, right? So maybe this was your plan all along. You put on this short strangle just so you can collect a little bit more premium here. And if it breached the call side, you would just roll the puts up and up and up. But if it breached the put side, you were fine with just letting it expire. And now you have 100 shares of DraftKings, and now you can play against that accordingly. So those are kind of things to be aware of when getting assigned on the short puts. And if we did have this spread it out, if we did have this as some sort of vertical and defined risk down here, well, obviously we would be collecting less premium, but we would be protecting ourselves just a little bit. But there is always a chance that you will get assigned if this trades in the money. So if the whole spread trades in the money, you're not going to get assigned. If DraftKings comes down here to 44, you're not going to sign. Or if your account is really small and DraftKings expires here at 47, you will not get assigned as well. If your account's remember the Robinhood guy that was trading the bull put spreads on Amazon, and he had like 3 of them or 10 of them or something like that, and his account got all jacked up. And then it takes a day for everything to settle. So if something does expire in the money and you get assigned, it's going to look crazy for a day, but then you just wake up the next morning and everything's clear. If for those of you with small accounts and stuff. But remember, he did it on Robinhood, and then Robinhood said, oh yeah, you got assigned, however many shares of Amazon at this price, and his account was negative, and then he ended up committing suicide. That's just, he was protected and he didn't know it, right? Because first off, it was spread it out. So there was a very small chance that he was actually getting assigned because you had these longs to kind of protect you just a little bit. But again, his account was so small that Robinhood wouldn't have let him do that anyway. It would have settled, it would have cleared, and everything was fine. So if your account is small enough to where 100 shares of DraftKings here, if you can't afford it, then obviously you don't have nothing to worry about. But again, if you are expiring in the money and the long option is expiring out of the money, you do have a chance of getting assigned. Also, with the call side, if this were to breach out here, obviously you would be on the hook for purchasing shares wherever DraftKings does expire. Then you'd be selling it back here. But again, if you're protected with a long, you're spread it out here, you don't have anything to worry about at all because you have these longs protected here. And again, you expire in between, or you expire in the money, but your long is still out of the money. There's a slight chance that they might try to call those, but really it's not going to happen, especially if your account is small enough. And again, getting assigned in your long calls, like I said, with my Peloton play, that it was just a lotto and I just kind of held on to it and see, what happened. And then it was like less than 10 cents expired in the money. I still got called on it. So it basically, all it is you have a call here. It expires however much in the money with that extrinsic value. You keep that extrinsic value, and then you just purchased 100 shares at $50 here for DraftKings. That's all that is. And you just got to be aware of getting assigned, and if you want to or not, and what you are going to do going forward with those 100 shares or with the loss of those 100 shares. Okay. So if you're doing a wheel strategy, are you going to continually keep on rolling that wheel strategy, right? If you're fine getting assigned on your 100 shares on short puts, now what are you going to do? Are you going to sell a covered call against it? You're going to sell a covered spread against it, right? If you're fine having your short call, it just ripped up, right? It ripped up. You weren't ready for it. You have no protection because it's just a regular plain old short strangle. The calls are up here at 55, and the stock is up at 60. What are you going to do? Are you going to try to hurry up and purchase shares and get those taken away? Are you going to roll up your puts? And it all depends on what fits your account the most, and if you actually getting assigned those 100 shares or not, or if you already have 100 shares or the money to put up, if you have to pay for, if you have to buy back shares and then sell them, etc. So again, all depends. Kind of a long-winded kind of ramble there, but it's very good information to have as far as when you're utilizing different strategies. You know what I mean? Be it iron condors, verticals, jade lizards, any undefined risk trade, just exactly what is going to happen. And then going forward, what are you going to do with those shares or the lack of the shares or the money in there? Okay, guys, thanks for watching. Make sure to check us out on social media. We have attached links to our socials in the description. And we also have a swing trading service if you're interested. There's more information in the description below.